the most important tax planning form of them all, Form 926, also the most forgotten. And as the form says right here, return by U.S. transfer or a property to a foreign corporation. This applies to almost every type of capital transfer of any type of asset, cash, property, intangibles, to a foreign corporation, even if you're not a controlled shareholder. There are some exceptions. One, if you're less than 5%, there is a transfer of cash is really important. And you're going to see the instructions here. And you want to really keep in mind that this form dovetails with Schedule O of Form 5471, which we're going to get to next because the two go hand in hand. The part I really want to pull out of this form and let you pull it up when you need to, or just pull up this video, is the exceptions for filing, and they're down here. And they are very unique, and usually a closely held business will not have any of these exceptions. They have to do with reorganizations, most of the time of a C Corp, most of the time of a publicly traded company. This law, which is Section 367, was written back in the 1960s when international work was done by publicly traded companies. So look at the exceptions. We'll go over them briefly, but they're not going to really apply to you. Section 355 is a spin-off, not too common. Section 367, less than 5%. This is probably the most important thing. So if your client is investing in some type of a foreign investment company, like maybe a Vanguard fund, this form probably wouldn't be required. But other than that, the safest thing to do is to file the form, and the reason is this page, the penalties. There's so many penalties. 10% of the value up to $100,000. And keep in mind, Chemical has told us that what CPAs are responsible for is tax penalties, not additional tax, but the penalties. This one is a big one. We don't see it too often. I mean, we don't hear enough about it because it deals with foreign transactions, but it's 40% of the underpayment of the tax. And then up in this paragraph, the 3-year rule, the extension, the statute of limitations does not start to run until 3 years after you file this form. So the whole tax return is subject to audit, which means any part of the controlled foreign corporation activity. So you may file Form 5471 and think you have closed off the years of your controlled foreign corporation. If you miss this form, you have not. So this is why it's so really important. As you go through the form, it's going to start to talk a lot about regulations. This is one of the few forms that you need to have your regulations close by, just to be sure that you have not missed something. Now, we saw before we got to forms the discussion on whether or not a foreign entity is a corporation or trust. That's really important. If you think it's a trust, you file, and it turns out to be a corporation, you have Form 926 after you. If you think it's a corporation, it turns out to be a trust, you have Form 3520 after you. So in my practice, we generally go to the IRS to get a ruling on any type of business entity other than a straight corporation. For even some LLCs in a foreign country can fall into this, what I call a hybrid arrangement. So with that, we're going to go over to the forum and get some good planning